How do you accurately value farmland in a REIT? Imagine trying to put a price on a piece of land that grows your food and supports local communities. That's what valuing farmland within a real estate investment trust involves. It's a mix of general valuation methods and specific agricultural factors. First, the most common approach is calculating the net asset value. This means adding up the market value of all farmland owned by the REIT and subtracting any debts or liabilities. To do this accurately, you need to estimate the fair market value of each parcel. This involves looking at how much income the land generates, usually from rent or farm operations. Then, you apply a capitalization rate, which reflects the risk and expected return for farmland in that region. For example, if a farm makes $100,000 a year and the cap rate is 5%, the land's value would be around $2 million. You also consider other assets like irrigation systems, barns, or hunting leases that can add to the value. The second method is discounted cash flow analysis. This projects future income from the land, including rent, crop profits, and land appreciation, then discounts those cash flows back to today's value. This requires assumptions about crop yields, commodity prices, and rental rate growth. For example, if you expect corn prices to stay steady and rental income to increase slightly over 5 years, you can estimate the present value of those future earnings. The third approach looks at funds from operations and adjusted funds from operations. These metrics adjust net income by removing non-cash expenses like depreciation, giving a clearer picture of how much cash the REIT can generate from its farmland holdings. This helps investors see if the REIT can sustain dividend payments. The last method involves comparing the REIT's valuation multiples, like price to funds from operations, with similar farmland REITs or recent land sales in the same region. If the multiples are lower than comparable properties, the REIT might be undervalued and vice versa. When valuing farmland, it's important to consider factors like crop income potential, soil quality, climate, and crop types. For example, a farm in the Midwest growing corn and soybeans will be affected by commodity prices for those crops, while a California orchard might be influenced by fruit and nut prices. Local land market conditions also matter. If farmland nearby has recently sold for high prices, that sets a good benchmark. Additional assets like irrigation or leases for energy production can add value but also bring complexity. Diversity in location and crop types influences risk and valuation multiples. For example, a REIT with farms in different regions and crop types spreads risk and can command different cap rates. For investors, comparing the REIT stock price to its net asset value per share helps identify if it's undervalued or overvalued. Reviewing the funds from operations and adjusted funds from operations metrics shows how well the REIT is generating cash. Also, understanding regional land markets and crop trends helps interpret valuation multiples. Combining these methods and factors gives a clear picture of farmland value within a REIT. It's about blending standard real estate valuation techniques with specific agricultural knowledge to reflect the unique qualities of farmland assets.